I'm Sean Aylmer, and this is a Fear and Greed extended interview. All the other good bits we couldn't fit into the daily podcast. If you're looking for the daily episode of Fear and Greed, check the podcast playlist. Otherwise, enjoy the interview. The housing market is hot right now, no doubt about it. Is it something governments and regulators should be worried about? To help us out this morning, I welcome back Carlos Cacho, Chief Economist at investment and advisory group Jarden Australia. Carlos, welcome back to Fear and Greed.
Thanks for having me, Sean.
Let's start at the very beginning. Why is the housing market so hot at the moment?
Well, the key reason, and what we see as the key driver of house prices, is really interest rates. The biggest driver of house prices is how much you can borrow from the bank. Usually you're not fronting up $1 million in cash to buy a house. Usually you've got a deposit of 10, 20, 30%, and you're borrowing the rest from the bank. And the biggest driver of how much you can borrow is going to be how much you can afford to repay, which is really set by interest rates. And what we've seen over the last year is interest rates on variable loans have fallen from 3 and a bit to 2 and a bit. And for fixed loans, they've fallen even more. You can actually get a 4-year fixed rate loan at under 2% now. And what that has done is it's allowed people to borrow up to around 20% more than they could back in late 2019. And as a result, we're seeing a lot more money flow into housing.
Wow. So the way you just put that, you can get 20% more. Does that mostly flow through to house prices because there is limited supply?
That's our view, is that essentially borrowing capacity is the biggest driver of house prices. In a market where there's pretty stiff competition, as there is at the moment, where the supply of good quality dwellings for sale is actually relatively low compared to history, what you're going to see is people are going to generally be increasing their borrowing capacity to borrow close to that limit, or at least the marginal buyer will be, and that's going to be pushing prices up. So our expectation for the year or two ahead is that we see a 20% rise in house prices. We've already seen them lift about 8% so far in 6 months, which is the strongest housing recovery on record. Very possible that we could actually overshoot that 20% given the strength in the market at the moment.
Okay, so when I go to a bank and I have $200,000 and I borrow $800,000 for the $1 million home loan, what's the bank thinking about in terms of my capacity to repay? It mustn't be assuming that over the 20-year loan or 30-year loan, I'll only be charged 2.5% interest. It must have some sort of buffer there.
Yeah, so at the moment, that buffer is 2.5% above the current interest rate. So it used to be a minimum rate of 7.25%, but in 2019, following the elections in July 2019, APRA reduced that buffer to just be a flexible 2.5%, which means if you're borrowing at 2.5%, the bank will assess your ability to repay the loan at 5%. Now, while that's still relatively low compared to history, it's important to realize that 2.5% is still quite a few rate hikes from the RBA. That's actually 10 hikes. And the moment, given we're at record lows and the economy is picking up fairly strongly, but the RBA is not expected to hike rates till 2024, it's probably going to be quite a while before we see 10 rate hikes from the RBA. So at the moment, the banks are pretty comfortable using that 5% buffer. But at some point in the future, it is possible that might be low, but that's quite a ways away.
When they talk about lending standards, and the Reserve Bank and APRA have both come out in recent weeks and said that lending standards were robust at the moment, and if there is to be a move to try and cap house prices, most economists think it will come through lending standards. Can you explain that a little bit, what we're talking about?
Well, lending standards are a pretty broad category. I mean, it can include everything from how the banks assess your income. So historically, what we've seen is banks generally haircut less certain forms of income. So for example, commissions or bonuses will often have a haircut when they go into the serviceability calculators. It can also include how they treat rental income. So similarly, there might be a haircut on the rental income because the bank will assume that maybe your investment property is only actually going to be tenanted 70 or 80% of the time. And it's also going to be looking at areas like your expenses. Historically, the banks have used what's known as the HEM, or the household expenditure measure, as a baseline for expenses, which is essentially a sense check on what you declare to the bank. So if you're declaring very low expenses, the bank will default to using the HEM instead, to just make sure they're not putting unrealistically low assumptions for how much you're spending. And that's one area of lending standards that has really tightened up over the last couple of years. If you go back to 2015, 2016, the HEM was set at probably around $3,000 a month for a family of four. Now it's risen to closer to $5,000 a month, according to some brokers that I've spoken to. And that means that the banks, as much as we've seen maybe loosening on areas like that serviceability buffer from APRA that I just mentioned, you've seen tightening up on the household expenditure measure. So the assumption that banks use for your expenses. And as a result, we've seen borrowing capacity has still gone up, but it's not gone up as much as you might otherwise expect. The other area of, lending standards that specifically APRA and the RBA are looking at is they're looking at measures of higher risk lending. So the key focuses there are things like interest-only loans and investor lending, which were very strong previously in 2015, which led to APRA to intervene in the market with macroprudential measures back then. And more recently, looking at things like higher LVR lending, so the share of loans with a loan-to-value ratio above 90%, and higher debt-to-income lending. So that's the share of lending where borrowers are borrowing 6 times or more their income. And those are really the key areas that APRA and the RBA are looking at for signs that maybe the banks are taking a bit too much risk on, or that borrowers are taking on too much risk, and that they might need to be concerned.
So when they do become concerned, what are they going to do in terms of macroprudential tightening?
Well, it really depends on what they're concerned about. What we saw previously from APRA is that they brought in limits on investor lending and on interest-only lending. And that was because those were the areas where the risk was building up in the housing sector, because we had investor lending at more than 10 times and we had interest-only lending at about 40% of new loans. At the moment, both those areas are much lower, and so APRA is unlikely to bring in limits there. If they're concerned about higher debt-to-income lending, which is one area that we think they could target, then they could bring in either a cap, and they could tell the banks you're only allowed to lend up to 7 times a borrower's income, or they could bring in a limit on the share of loans above 6 times. So they might go out to the banks and say you're only allowed to lend up to 20% of your new loans can be at greater than 6 times. Debt to income greater than 6 times. At the moment, that's around 17% of lending. So there's still a bit before we get to probably levels that APRA would be worried about. If APRA was just more concerned about the sheer volume of lending and they just wanted to slow down lending generally and wanted to soften the housing market a bit, they could use a tool known as the counter-cyclical capital buffer. That's essentially an extra amount of capital that APRA can force the banks to hold, which is just going to mean essentially that they have to hold more insurance against the lending they've got out. So, and that's going to slow things down, because it's going to mean they have to raise reserves or raise capital a bit more for each new loan they make.
Okay, so there's lots of things they can do before worrying about lifting interest rates.
Yeah, exactly. And I think the thing there here that's important is what we've learnt in the previous housing cycle, kind of that period from 2017 to 2019, that downturn, is that macroprudential tools can be very effective at limiting the housing market. And really, they're arguably a better tool than interest rates. The problem with using interest rates to control the housing market is not only does it impact housing and lending, but it's also going to impact the rest of the economy. And right now, when the RBA is trying to drive a strong economic recovery from our first recession in 30 years, the last thing they want to be doing is weighing on economic growth and slowing the recovery in the labour force and inflation in particular.
Carlos, stay with me. We'll be back in a minute. My guest this morning is Carlos Cacho, Chief Economist at Jarden Australia. Do you think the Reserve Bank and APRA are particularly concerned about housing at the market? They seem relatively sanguine, but do you think that's the case?
I think, look, based on all their recent public comments, I think it's certainly something that they've got their eye on. Evidently they've been telling us this. They've been saying, we're watching lending standards closely, but I don't think they're concerned about it yet. Wayne Byers, APRA chairman, was very clear in his comments to the House Economics Committee and the AFR Banking Conference last week when he said it's not their job to sell house prices, and that they're not seeing a deterioration in lending standards. So he was pretty clear that they're not too concerned yet, but I certainly think they're watching it. That said, if you look at the pace of house price gains we've seen recently, they're pretty eye-watering. On a 3-month annualized rate, national house prices are now up 25%. They're up even more in Sydney. They're up by about 30%. And if you just look at houses, so excluding apartments, they're up by 37% on a 3-month annualized pace. So that's a pretty blindingly fast recovery. And as I mentioned earlier, it's the fastest housing market recovery we've seen going back to the 80s. So it's a very rapid pace. I think if this continues for a few more months, then maybe the RBA and APRA will be getting a little bit uncomfortable with that. I think it is true you can have too much of a good thing. And while the RBA certainly wants to support the housing market, it's going to be a key driver of the economic recovery. They don't want to risk building up of financial stability risks in the system that could eventually lead to potentially a more damaging correction. So I think the key thing here is it's really going to be about balancing enough of the housing market recovery to support the economy, but avoiding maybe too much excess lending and excess borrowing building up in the system such that we could potentially see a more damaging correction down the line.
I remember Matt Comyn must have been back in February, Matt Comyn being the boss of Commonwealth Bank, coming out and saying this time around house prices were surging in regions and outside Melbourne and Sydney. But in that last 4 to 6 weeks since he made that comment, house prices in those capital cities have surged. And his point back then was that regulators wouldn't be as worried if they weren't surging in Sydney and Melbourne. But certainly Sydney, that seems to have turned around.
Yeah, look, we're really seeing it across the board now. So you're absolutely right. Early on in the recovery, if we look back to kind of mid to late 2020, the regional areas and the smaller capital cities were really the drivers of this. You're looking at cities like Brisbane, Adelaide, Perth as well, picking up. The real strength was out of the major cities. Now we're seeing Sydney and Melbourne join the party as well. So it's very much a national phenomenon. And I think that's positive, though, in a way that the benefits are going to be more evenly spread across the country. And it should drive more economic uplift than if this was just a Sydney and Melbourne centric story. But I think it's also important to not just look at it across the spectrum of Australia, but also globally. If you look globally, in New Zealand, in the US, in the UK, pretty much around the world, we're seeing house prices surge. In the US, house prices rose at the fastest pace since 2006, I believe it was. Last week, the data came out. So we're seeing this around the world, and it's really all driven by low interest rates. We're seeing record low interest rates in pretty much every country as a way to combat the economic recession driven by COVID-19. And as a result, we're seeing money pile into real estate and real assets generally. So it's it's really a global phenomenon. It's not just unique to Australia.
Just a couple of things quickly. First home buyers, they certainly came back into the market, though in February, I think the figures suggested they'd dropped off a little bit. But there's definitely a rush of those guys back in the market.
Yeah, absolutely. If you look at first home buyers, the share of total lending, they're up to about a quarter of all loans. And of owner-occupiers, they're above a third now. So that's the highest we've seen since back in 2009 when we had the first home buyer incentives brought in post-GFC. So they're really a key driver. What really sets this housing recovery apart from the prior periods we've seen is that it's really mostly driven by owner-occupiers and first home buyers well within that. And that's another reason why the regulators aren't as concerned at the moment, because it's not investors who are leveraging up, who are buying speculatively. It's owner-occupiers who are buying houses to live in. And I think a lot of it also comes down to people, due to COVID, maybe wanting a bigger house, realizing that if I'm working from home 2 or 3 days a week, or if I'm not having to commute in the city, maybe living in a kind of the outer suburbs or in a lifestyle area close to the city is actually more feasible. And so that means that the performance of detached housing is quite different to units. Units, we're not seeing the same kind of rapid price growth that we're seeing for freestanding homes. And that's really driven by this theme of owner-occupiers coming in, wanting more space, looking to upgrade, and realizing that maybe you can actually live a little bit further away, and that maybe what was seen as a too long commute previously is not so bad if you only have to do it 2 or 3 times a week.
We'll be back with more in a moment. I'm talking to Carlos Cacho, Chief Economist at Jarden Australia. So the other thing I just wanted to mention, and it comes back to units a bit, is immigration. And certainly the housing market in Australia has benefited from net negative migration. What do you think that means for the market?
I think that's going to continue to weigh on units, particularly in the CBDs of Sydney and Melbourne. If you look at where immigration goes to within Australia, the vast majority of migrants come to Sydney and Melbourne. And so that's really going to weigh more on those inner city unit rental markets. And we're seeing that play out in both vacancies and rents. We're still very elevated vacancy rates, and rents have fallen quite significantly. In some cases, you've seen rents down 10 to 20%. for some buildings. Where you're not seeing that weakness so much is in the other cities, and that's partly driven by the fact that you've actually got internal migration. So the ABS has released data ahead of schedule due to kind of trying to pick up the trends from COVID. And what we've seen is record migration out of Sydney and Melbourne into both regional areas and to Queensland, particularly Brisbane. So those other cities are being more supported by that internal migration pattern, whereas Sydney and Melbourne, the lack of foreign immigration and people leaving is going to be a drag on those inner city areas. And I think that's going to be why that those apartments in, the Sydney CBD and areas, Melbourne, Docklands, etc., are not going to probably perform as well as houses will.
Carlos, it's an incredibly fascinating subject and something that we're all a little bit obsessed about because it affects us individually.
It absolutely is. I think, talk to anyone in Australia, housing's always a hot topic of conversation, whether it's over a morning coffee talking about the auctions over the weekend or at a barbecue. And it's a huge driver of economic growth. Housing drives a lot of consumer spending. It drives construction. Construction employs almost 1 in 10 Australians. So it's a massive sector for the economy. And I think it's really going to be a key driver of the recovery as we continue with this post-COVID economic recovery.
Carlos, thanks for talking to Fear and Greed this morning.
Thanks for having me, Sean.
That was Carlos Cacho, Chief Economist at Jarden Australia.